Is President Biden softening his anti-oil stance ahead of the 2024 election? And why is Tesla facing so many investigations from the Justice Department? Yahoo Finance highlights these stories and more for Inside Washington.
Warren Buffett strikes again. The Oracle of Omaha is upping his bet on Occidental Petroleum. Buffett boosted his stake in the energy giant to 25.8%, snapping up almost 4 million common shares, giving him a total of 228 million shares in the oil giant. Now, his total stake in the company now sits at about $14.5 billion. Well, it's been a gangbuster quarter for the U.S. economy. GDP rising by 4.9% during the third quarter, powered by the consumer that stands resilient in the face of inflation. Though soaring bond yields may have done some of the Fed's work for it, it's clear stubborn inflation has a ways to go before the Fed hits its 2% goal. So what can we expect from the Fed next week? Well, joining me now is John McClain, Brandywine Global Portfolio Manager. Good to have you on the show here. So give us your expectations here. I mean, we're about 18 months in of interest rate hikes and pauses here. What are the expectations coming into the next meeting?
Well, you hit the nail on the head with your introduction here. GDP is strong, the consumer is strong, inflation's coming down, but not as quickly as the Fed would like. I don't think we're going to see any surprises in the next meeting here. I mean, we're not hiking this time around, but I do think that there's potential for an additional hike to be coming into the market probably in December. And I think the Fed's going to have to talk tough at this point because the economy is strong, because equity markets, despite the recent sell-off, are still performing reasonably well. The Fed's got a lot of work to do here, and it's fighting fiscal stimulus as well at this point.
And in terms of the tools that the Fed is using, you noted that COVID didn't kill the U.S. economy. In fact, it structurally altered it. What does that mean then for the Fed's approach as it's looking at the strength of the economy at the moment and still in this high interest rate environment and inflation still sticky?
Yeah, I mean, the Fed can't act alone in isolation, right? And I think, as we mentioned, you've got a cocktail of financial engineering, loose fiscal policy, stimulative government programs that have all been counteracting what the Fed's doing. And also, I don't think it's talked about enough at this point in time, but the Fed's balance sheet's massive. It's massive relative to GDP and relative to its historical positioning here, and that's still very stimulative. So the Fed used to have kind of the lay of the landscape, and monetary policy had a strong transmission mechanism. It's not the case today. They're fighting a lot of counterbalancing forces.
And, people are looking at their retirement, they're looking at their 401k, and the Fed does not care about your 401k at the moment. At what point does that narrative change, though?
Well, Jay Powell's Scrooge McDuck, right? Like, yes, he definitely does not care about the stock market or the 401k. And I think that's a misnomer that a lot of people thought that the Fed stepped in March of 20 as the stock market was crashing. That was not why they came in at all. They came in to restore order to fixed income markets, particularly treasuries. You could not trade treasuries for a point in time, basically, during the depths of COVID. And that's what the Fed cares about. It's orderly financial markets. They don't care about the stock market. And really, we would be massively far away from a Fed put at this point in time.
And of course, I have to ask you about the action that we've been seeing with bond yields and the impact that's been having on stocks, that dichotomy there. What are your projections for where this goes from here? I mean, we're going to be in this holding pattern of higher for longer interest rates, clearly for the foreseeable future.
Yeah, and we've said that. And this is a generational opportunity for investors to shift capital away from equity into fixed income. The relative attractiveness of fixed income compared to equity markets is as strong as it's been in 20 plus years. What we think is areas of the market that are relatively short duration are particularly interesting at this point in time. So we highlight high yield at 9.5% yield is forming kind of a Goldilocks opportunity for investors with low default rates, low dollar price of bonds, and high yields. The longer part of the Treasury curve is particularly challenging at this point. What we're watching closely here is where the 10-year closes. And if we close above 5% at a point in time, I think that could potentially lead to a real blow off in back-end yields. We could see yields jump massively here. And what you got to pay attention to is the ineptitude of Washington, D.C. at this point. You've got politicians that, it takes 3 weeks and, 4 speakers to elect the new speaker. I think we're going to have to wait and see around fiscal discipline coming out of DC, because if we don't have that fiscal discipline, you could see a material rise in back end interest rates.
And certainly, when you have a new speaker now who is, he's pro-Trump, and it's going to be a tough sell here to try and get some sort of, to avoid a government shutdown here. When you couple that also with what we've seen, as you mentioned there, with the inverted yield curve, when you couple that with a potential recession, then what are your recession estimates? How deep do you think it's going to be, and what could potentially change that narrative?
Well, look, we were early to a recession call in 2023, and I think, as we briefly mentioned, financial engineering and creativity from CFOs has really prolonged this cycle. And I don't think we're going to see a recession in the next 12 months here. So I think it's continued to be pushed out. But in terms of where we see bond yields going, again, the back end of the curve is relatively murky, but the front end of the curve is reasonably, if not particularly attractive.
And what else do you find attractive in this sort of environment? I know we talked about fixed income here. So what are some of your favorite picks at the moment?
Well, again, from an asset class perspective, we like to stay relatively short because the curve, while it's inverted, has gotten less inverted. So we want to take some duration, which means rotating a bit out of floating rate and into high yield. We find a lot of value in the mortgage market. Mortgages are exceedingly cheap, but they're cheap for a reason. Until the Fed comes in and buys, until banks buy, mortgages are going to remain relatively cheap. But if you're a buy and hold investor and you have a 5 to 10 year time horizon, fantastic opportunity there. Investment grade corporates are reasonable at this point as well. So there's a lot to like in fixed income. And from our perspective on the equity side of things, look, you're trading at 19, 20 times PE, and the cost of capital has gone up 500 basis points over the last 18 months. And so that cash flow is going to be servicing debt as opposed to paying dividends and share buybacks. So again, we think the relative trade is out of equity and into fixed income across a number of different asset classes.
And especially still in the thick of earnings season here, is that giving you any sort of expectations as we're looking ahead to the following quarter?
Earnings are coming in fine, right? Like I think when you look at the Magnificent Seven, some of the generals are starting to get shot here a little bit, but it's not based on the fundamentals of the business. It's based on longer term expectations as well as valuation. So I think what we're seeing generically is reasonable earnings from these companies. And what I would point to and why we're so constructive on corporate credit is the fact that these companies have had 18 months to figure out their balance sheets, and they're seeing rising interest costs, and they're not borrowing, which is fantastic and very supportive for debt holders. But earnings expectations, I think, are reasonable at this point in time. They're going to start to come down as we see the impacts of rising interest expense on corporate EPS, but it's going to take a lot longer than I think the market anticipates.
I'll certainly be watching that. Appreciate you taking the time to join us this morning. John McClain, Brandywine Global Portfolio Manager. Thank you so much. Well, crypto has been at the forefront for lawmakers for months. This morning, the Senate Banking Committee convened to discuss risks surrounding digital currency and how it could play a role in terrorism around the globe, especially in light of the Israel-Hamas conflict. Well, joining me now is Republican Senator of Wyoming, Cynthia Lummis, to discuss more. Good to see you again, Senator. So talk about some of the findings that we've seen here, because I know that crypto and digital assets were part of the discussion about illicit financing, but how much of it is represented here in the illicit funding?
Rochelle, thank you. It's nice to be with you. It's a small part of the overall funding, but the fact that it is a part of the funding is what makes it of interest to me and of concern to me. We know that Binance has been used to funnel monies and contributions to Hamas. So it's absolutely important that we have these heretofore unregulated companies in the United States come into our system, be regulated, that they vet their customers that they comply with the Bank Secrecy Act, that we have efforts through FinCEN and other means to stop the use of cryptocurrencies in illicit finance. We know it's being used. It's to a smaller degree than perhaps was reported in the Wall Street Journal, but nevertheless, we know it's being used. We have screenshots of Binance's logo on solicitations for illicit finance.
So then, Senator, how do you close some of the gaps and the loopholes here that are allowing some of these countries and these users to circumvent sanctions and some of the existing policies?
Senator Kirsten Gillibrand and I have a comprehensive bill called the Responsible Financial Innovation Act that would provide additional resources to FinCEN, would call for a study of the use of mixers and tumblers. We also know that Treasury is already doing some good work to begin that effort regarding the use of mixers and tumblers to secure anonymity in illicit finance. We need to make sure that the Justice Department, when we have known violations, Binance, Tether, and other uses where it's been told to them that their customers are using their platforms for illicit finance, and then they'll take them down for a short period of time, and then those sites go back up. These are the kind of things that need to be policed in the United States by U.S. regulators. The Lummis-Gillibrand bill will augment those efforts, those resources, and make sure that countries that have the reach of U.S. regulation are complying with the Bank Secrecy Act and the Anti-Terrorism Act. We have a portion of our bill in the National Defense Authorization Act that already passed the Senate. We want to make sure that that part stays in the final product. We've got to get at the illicit finance use of cryptocurrency.
And certainly will require some international cooperation as well, as some of these transactions essentially borderless. We do appreciate you taking the time to join us, Senator. Cynthia Lummis, Republican Senator of Wyoming, thank you so much for joining us this morning.
My pleasure. Thank you.
It is official. Representative Mike Johnson is the new Republican Speaker of the House. And with less than a month to work out a budgeting deal to avoid a government shutdown, the new leader has a lot to get working on. But who is this congressman from Louisiana? How did he get here? And what does it mean for the House? Yahoo Finance's Rick Newman joins us with what's keeping him up at night and what's worth keeping on your radar. Rick, sorry, I added in a little line there, but I imagine that this has been keeping you up at night a fair bit.
Well, I get some sleep now that there's actually a speaker. You don't have to follow the speaker follies every day, but we'll see how long that lasts. So Mike Johnson is more conservative than the last speaker, Kevin McCarthy. He wants to cut spending along with some of the other hardline Republicans. He has opposed aid to Ukraine, and we're going to find out within a few weeks whether he becomes a little more pragmatic and a little more moderate now that he actually has to get business done in the House. He probably will be. Because when you're a lesser known member of Congress, it's easier to make controversial votes. I mean, for example, he's an election denier. He voted against certifying President Biden after the 22 election, which Biden obviously won. And he didn't catch a lot of flack for that. I mean, he wasn't one of the main people either for or against the cause. But now, reporters in the Washington Press Corps are asking him about it. He has to answer for it. He hasn't. So that's the main question. I mean, what we've seen during the last month is that the Trump or the hard right faction in the Republican Party, it sort of has blocking power or veto power, if you will. They can stop stuff from happening, but there aren't enough of them to actually make their own agenda happen. So that's where we are. And look, in order to pass budgeting bills in the House, get aid for Ukraine, for Israel, these other things, parties have to compromise. I mean, this is the way Congress works. Parties do have to compromise. So that's the big question. Is he going to find a way to compromise with Democrats because he's going to need some of their votes? Or is he just going to be kowtowing to this small but veto minority that Republicans have, which means he could end up defenestrated just like Kevin McCarthy did by some point next year.
Rick, you mentioned that he was one of the election deniers, just in terms of where he has stood on other policy issues, how that then could potentially shape what we see coming out of the House here over the coming year. I guess, how do you see that potentially playing out, and how that could then maybe ultimately affect in some way 2024?
He's extremely conservative on social issues, such as abortion and things related to that. That doesn't affect markets so much. I guess the thing that our audience will want to care about is he does want aggressive government spending cuts, more than Democrats and Republicans agreed to last June when we had that fight over the debt ceiling. So is he really going to push for that? And remember, Democrats control the Senate. So even if he gets Republican legislation approved in the House, a Democratic-controlled Senate is not going to approve it. And then what do? I mean, the Democrat-controlled Senate is not going to sign off on aggressive spending cuts. So are we going to have some kind of gridlock? Are we just going to have repetitive threats of a government shutdown, and then everybody has to scramble to figure out what does that mean? Probably doesn't hurt markets too bad for just a couple of weeks, but what if it goes longer? Or will we have some semblance of normalcy in Washington for a little while? I think that's the big unanswered question at this point.
Certainly is the unanswered question. All right, Rick, always great to get your perspective. And now we're going to let you maybe catch up on a little more sleep, like Brad alluded to at the top there. Rick, thanks so much.
Bye, guys.
It's been a busy few weeks in the energy sector, with Chevron and Exxon buying up competitors in those double-digit billion-dollar deals. This power move comes as fossil fuel companies have raked in profits under President Biden, despite his green energy agenda aiming to push more focus on renewables. So is Biden losing to big oil? Rick Newman has been following this. How should we be framing this, Rick, from a political perspective?
First, just a couple of facts, Julie. Exxon and Chevron both had their most profitable year ever in their history in 2022. And for each of those companies, their stock hit a record high shortly after that. And they've just been raking in cash since Joe Biden has been president. Now, that is a coincidence. That is not a result of any policy Biden has put out there. In fact, as everybody knows, Joe Biden favors green energy and renewables, and he signed the most aggressive green energy incentives into law in 2022 in the so-called Inflation Reduction Act. And yet, fossil fuels are thriving under President Biden. So, to me, the important takeaway is everybody thinks that the president signs a piece of paper and it can either benefit this industry or kill this industry. And it just is not that way. I mean, the fossil fuel industry, Exxon, Chevron, the companies they're buying, they're doing great because of what's happening in the market. And Biden is not stopping that. I think President Biden has learned a super important lesson during the last 3 years, which is that as much as you might wish, we could burn less carbon in order to reduce global warming and get climate change under control. We are dramatically dependent on this energy, and we're going to be for a long time. And you were talking in the previous segment about this idea of peak oil. We're not even at peak oil. Peak oil is when global demand for oil is likely to hit its maximum level and then gradually come down. And we may not hit that for another 10 years or even 15 years or so. So fossil fuels are here to stay, and it's no accident that these companies are doing so well.
And Rick, as you rightfully pointed out, President Biden, listen, he's gone after big oil before, gone after Exxon in particular. Why do you say that he's learned his lesson, though, Rick? You don't think that maybe these kind of headlines draw him in again, try to politicize this a bit?
Because of gasoline prices, simple, and to a lesser extent, winter heating costs. Biden got completely burned by gasoline prices in 2022 that hit $5 per gallon, the highest they've ever been in the United States. It's clear that the Biden administration has gas price PTSD because they are going around the world doing everything they can think of to try to make sure there's going to be plenty of oil on the market. They just released some sanctions on Venezuela to coax, Venezuela barely puts much oil into the global market, even though it has so much oil. So there's going to be a little more Venezuelan oil coming next year. The Biden administration is doing that to keep gas prices down because they think that if gas prices surge again in 2024, when Biden's running for re-election, he'll lose. They got scorched by that in 2022. They're scared to death it's going to happen again. And you are not going to hear Joe Biden trashing fossil fuels the way he did as a presidential candidate in 2019 and 2020, because he knows not only do we desperately need them in the economy, he desperately needs a lot of fossil fuels on the market if he wants to get reelected in 2024.
Things aren't getting any easier over at Tesla. Worse than expected earnings, issues over the Cybertruck, and now more investigations. Elon Musk's company revealing its automated driving systems are under deeper federal scrutiny. The EV maker revealed in an SEC filing the Justice Department is demanding info about the systems and a range of company actions. Yahoo Finance's Alexis Keenan has the details. Hey, Alexis.
Hi, Rochelle. Yes. So we knew back in January that the Justice Department had asked Tesla for more information on its autopilot and also its full self-driving systems. But in this new quarterly report, we're learning that the probes are quite a bit wider in terms of subject matter and also a lot more demanding of Tesla. And that's because the prosecutors have subpoenaed Tesla. So in terms of they're not asking for this information, they're telling Tesla that the company is required to hand over information. Now take a look at those range of issues there. It's not just autopilot and full self-driving features. The Justice Department also asking for information on personal benefits, related parties, vehicle range, and personnel decisions, they say. Now, Tesla offered no additional detail in the report about these probes, other than to say, to the company's knowledge, no government agency in any ongoing investigation has concluded that any wrongdoing has occurred. Now, that leaves us to some speculation. But what we do know is that as for the vehicle range, a number of news organizations have reported that Tesla's stated mileage range for its vehicles tend to not hold up in real life. And as for personal benefits, in August, the Wall Street Journal had a report saying that the Justice Department was looking into whether company funds from Tesla were used to create and design a glass house for Elon Musk. Now, last year also, Reuters had a report saying that the Justice Department was investigating Tesla's past self-driving claims. Though the company does maintain on its website that autopilot is not a self-driving system and that features that it offers like auto braking and lane correction, that those are meant to reduce driver workload, but they're not meant to have someone without their hands on the wheel. They say they're meant for fully attentive drivers is the way they say it. But the big takeaway here, Rochelle, I think that these expanded probes really add to this rough week that Tesla has had after its third quarter earnings call last week, and also to the existing investigations that we know about with the National Highway and Traffic Safety Administration. Those date all the way back to 2016. So a lot on Tesla's plate this week, and certainly an expanded and deeper range of probes here into the company and its practices.
Indeed, continuing to keep an eye on that story. Appreciate you getting us up to speed. Our very own Alexis Keenan.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.